What I'm about to share with you is extremely important. It doesn't take a rocket scientist to see that the stock market has been struggling for some time now, leading some people to sell and take massive losses. And I think a lot of people are looking at this the wrong way. A lot of people are thinking my account is red, I better sell. This market is simply too risky right now. And I'm going to go over in this video why maybe you should consider holding your securities, or dare I say, buying stocks. The past several months, I've been plowing boatloads of money into the stock market. Every dollar I can possibly spare, I am strategically allocating towards the stock market into companies I believe in and think are going to thrive over the next several years. But like I mentioned before, a lot of people don't see eye to eye with me on this. A lot of people see red and they see fear. But the common mistake a lot of people make is that the red is going to last forever. They think that the Red Dead Redemption they're seeing is the future and stocks will continue plummeting into the earth for as long as we know it. Well, here's the thing. I don't know how realistic that is. First and foremost, it's extremely dangerous to bet against the United States economy. While many people watching this may feel one way or another about the country as a whole, the United States is generally extremely good at innovation and finding a way. Meaning that although the economy and a lot of companies may be seeing headwinds in the short term, the odds of these companies seeing these headwinds forever are very low. In addition to that, when buying individual stocks, volatility is the price you pay when outperforming the market. Yes, it would be very easy to put your money in an index fund and invest passively, but if you want those big time returns, you have to deal with the volatility. Now, if volatility is not for you and you have no desire to deal with that at all, feel free to click off this video now. Just kidding. Please keep watching. But some of the best performing stocks over the past many years had their own dips along the way for a number of reasons. Example one, Amazon. There was a point in Amazon's history that the stock price was under $6 a share. Yes, that's not a typo. $6 a share, aka the price you pay for a large latte at Starbucks every single morning, is the same price this stock that is worth over $2,000 after it has declined quite a bit used to trade at. Granted, there were extremely relevant reasons why this stock was trading this low, from the tech bubble bursting to 9/11 to the internet being in its extremely early stages, and a lot of people being unsure if the internet thing was really going to take off. I know that sounds extremely weird to say now, but there was a time period where people thought putting their bank account information in a computer so you could pay for things electronically was one of the most idiotic concepts on the planet. I know, silly now, right? Anyway, the list here goes on and on. Amazon stock did recover from this $6 a share price and made its way to over $100 a share about 6 years later in October of 2007. About a year later in November of 2008, during the Great Financial Crisis, when we almost lost the entire financial system, Amazon stock was trading at around $35 a share, down around 65% from all-time highs. But if you zoom out on the chart and you zoom out on the company, Amazon has performed extremely well despite going through several tough time periods. This can be attributed to several different reasons, but at the end of the day, the long-term vision of Amazon had always stayed intact, and people who continued to acquire more shares and increase their ownership of Amazon throughout the decades of the 2000s are extremely happy shareholders. Example 2, Apple. There was a point when Apple was trading, obviously on a split-adjusted basis, at 14 cents a share. Granted, at this time, Apple was in a very different place than it is today. Now we know Apple as one of the most profitable, successful companies in the world, but what a lot of people don't know is at that time in 1998, Apple was a legit bankrupt candidate. Obviously, Apple got through this crisis and made it out to the other side, but even when Apple began to become a sustainable company, in 2012, Apple dropped around 45% from $25 a share, again on a split-adjusted basis, to under $14 a share. And even if you continue to go through Apple's stock price history, the company had many 10, 20, 30, and even over 30% drops. But if you continue to believe in the company and continue to acquire shares, you are once again an extremely satisfied shareholder. Google, AMD, Nvidia, and many more stocks all saw the same fate as Apple and Amazon, and many of these companies continue to thrive over the long term as their businesses develop. So what is the first lesson I'm trying to teach you here? The lesson is, if there are companies you believe in that you believe are going to thrive over the next couple of years, continue to acquire ownership of those companies. Remember, at the end of the day, you are making an investment. You bought into these stocks, into these companies as an investor, not just to make a couple of quick dollars so you can put gas in your car, but to ride out where the company is going to go over the long term. If something has changed with the underlying business, fine. But if the company is continuing to thrive, continuing to expand and make progress, I personally think it is better to increase ownership, because as you saw there are many companies, many more that I did not mention for sure, that have suffered drops that can be looked at as a complete overreaction. And when this happens, it usually works out in the investor's favor to buy more shares while the company is trading at a discount. Secondly, when stock prices dip as they have been, many retail investors tend to think that this is a much riskier time to buy. It's not. Mainly because, to keep it simple, simple, lower valuations provide lower risk. If you were looking to make money in Apple stock over the next 5 years and you were being stubborn and refused to put that money into any other stock, would you rather buy Apple when it's trading around a $2 trillion market cap or a $1 trillion market cap? I think everyone watching this can agree that Apple would be a much better buy at a $1 trillion market cap because the company is cheaper and the odds of them continuing to grow into a higher valuation are a lot higher if they're trading at a $1 trillion market cap compared to a $2 trillion market cap. So to summarize, it's not unrealistic by any stretch of the imagination to see these companies that you put your hard-earned money into drop 30+%. It's also not unrealistic for these companies to trade at that valuation for quite some time. But it's important to continue to acquire more shares of these companies because in the end, if you stick with your conviction and you've done your homework, it's going to work out for you in the long run. And in the end, the more money you're going to make. In addition, the lower the valuation is on these companies, simply the less risk you are taking. While it may be painful to suck through this in the short term, while you may constantly have those ideas of selling your stocks and sitting on the sidelines, in the end, if you have the stomach to hold, to go against the grain, to be an individual stock picker, it could very, very well work out in your favor.